Good morning to all of you. Dr. Ashutosh Agrawal from Dr. APJ Abdul Kalam Technical University, Lucknow, here to present you delivering a lecture on investment analysis and portfolio management. Today, the topic of discussion is fundamental analysis, economic analysis. What exactly the fundamental analysis? Fundamental analysis seeks to determine a company's outlook based on the factors related to companies itself. Sometimes we see the market is moving ahead, moving down, moving bullish trend, bearish trend, but what factors affect exactly the market? The investors are basically making the investments based on the waves running in the market, the price movements running in the market, but actually the prices of a particular security, particular stock is based on the fundamentals or related to that particular stock. The practice of evaluating the information contained in the financial statement, industry reports and economic factors to determine the intrinsic value of the firm. Once we have to go for the fundamental analysis, we have to analyze the fundamentals of an economy, fundamentals of an industry and fundamentals of a company. So, once the fundamentals of an economy, industry or a company is strong, then definitely an investor is preferred and moving ahead to make the investment in a positive manner. So, fundamental analysis is, there are few assumptions on fundamental analysis. These like the market price of a security is different from the price as justified by its fundamental factors, like the intrinsic value. Means once a prices movements are in bullish trend or bearish trend, they are little bit different from the fundamentals of the company's intrinsic value or fundamentals of that particular stock. And marketplace provides an opportunity for an investor to detect such discrepancy. The moment such a description is made, a decision to invest or disinvest is made. Means under the fundamental analysis, an investor is taking a decision whether to invest or not to invest, whether to invest or disinvest, whether to buy the security or the selling the security. This is not only based on the price movements, volume traded, but also the main thing is intrinsic value, intrinsic factor of that fundamental security, of that particular security. So, once there is a decision criteria for an investor, if the intrinsic value is more than the market price, then it is advisable for the investor to buy the security. Intrinsic value means the fundamental value, the core value of the securities, the value, the worth of the security based on the company fundamentals. If the intrinsic value is less than the market price, then definitely it is advisable to sell the securities. And if intrinsic value is equal to the market price, which is very rare, but once if this kind of situation arises when the intrinsic value is same equal to the market price, then as the investor prefer, if he or she needs money, then he make the disinvestment, or if he does not require the money, then he should hold its or his investment. The fundamental analysis, let us continue with the fundamental analysis. Fundamental analysis is analyzed on three grounds. These fundamentals are economic analysis, industry analysis and company analysis. Let us move ahead. Before moving ahead, we are analyzing the fundamentals of a particular company, fundamentals of a particular industry, fundamentals of a particular economy. If the economy seems strong, then definitely the investor make the investment. If the industry seems strong, then definitely the investor will prefer or invest in that kind of industry. And thirdly, if the company seems strong, if the financials of the company seems strong, then definitely the investor will go for that particular company investment. Let us start with the first point, that is the economic analysis. These are the fundamental stage where the whole is the economic analysis, under which we are having the industry analysis and the core is the company analysis. There are three factors in the economy analysis, industry analysis and company analysis. So, let us start with the economic analysis. Economic analysis, this is based on the economic factors, the macroeconomic factors, microeconomic factors, because this is the analysis for whole economy. Hence, under this economic analysis, an investor, whether the individual investor or an institutional investor, move forward for the macroeconomic factor analysis. On the basis of macroeconomic factors of an economy, an investor can analyze whether that economy is strong, weak or stable. Which kind of economy is it? Take the example of Indian economy, take the example of US economy, take the example of Canadian economy, take the example of Chinese economy. Which economy? Investors are preferring those economy. Investors wants to make the investment in those kind of economies where the fundamentals are strong, where the macroeconomic factors, macroeconomic indicators are strong. If the level of economy is high, the prices will be high, and vice versa. Means if the economy factor, if the level of economy is low, definitely the prices of the securities, prices of the market movement will be low in the bearish trend. So, an investor want to make the investment, if an investor want to make the investment, he should focus, the investor should focus firstly on the economic indicators. Economic indicators, mainly the macroeconomic indicators, because it analyze the whole economy as a whole. There are three category of economic indicators. Economic indicators that affect the analysis of risk and return on investment. Risk and return, economy, if the economy is strong, the risk will be low, the return will be optimum. If the economy is weak, definitely the risk will be high and return would be low. So, under this, economic indicators are the indicators which affect the economy through macroeconomic factors, and which consist or which depicts the economy or announce the economy as a strong economy or a weak economy. So, let us start one by one. First of all, there are leading economic indicators. Leading economic indicators measures that tend to move prior to or precede movement in the business cycle, indicates what is going to happen in the economy. Means these are the leading indicators, leading economic indicators which tell about what will happen in the future. These are the factors which analyze about the future price movements. Leading indicators often changes prior to large economic adjustments, and as such can be used to predict future trends. These economic indicators are the large indicators or before the investment indicators, which talk about, which can predict or which can expect the future trend or future movements in the price. These economic indicators, these leading economic indicators may have be the monetary policy of an economy, the fiscal policy of an economy governed by Government of India. Monetary policy is governed by the RBI for Indian economy. If we are talking about the productivity, the rainfall, the capital investment and stock indices. These are the leading economic indicators which talk about what would be the stock movements in the near future. These economic indicators, if the Government of India announces the fiscal policy and RBI announces the monetary policy, in which the CRR and SLR, the RBI is changing, if the CRR is changing or CRR is declining by the RBI, then definitely it will have the impact on the economy, funds availability, and funds availability in an economy will definitely talk about the economy will go ahead or will go down. And on the basis of economic movements, the stock movements, investment movements or price movements of a particular security or a particular market is talked about. So, these are the leading economic indicators like monetary policy, the rainfall, a very most important rainfall of an economy. Rainfall condition of an economy talk about what exactly the rainfall is. There is a drought condition, is there is a regular rainfall or optimum weather in an economy. Take the example of Indian economy. Indian economy is having a optimum weather conditions, where few months are having for rainfall, few months for winter season, few months for summer season and other things. So, under this kind of economy where the rainfall is optimum, the agriculture production will be optimum. Once the agriculture as a leading indicators of an economy, leading indicator for the GDP, and henceforth rainfall is the leading economic indicators which talk about where the economy will move, where the agriculture production will move. Let us have a next look on lagging economic indicators. These economic measures that tend to move after or follow movements in general economy like business cycle. These indicators, these lagging indicators, however, reflect the economic historical performance, and changes to these are only identifiable after an economic trend or patterns has already been established. Under this, they are the historical movement, they are taking the historical data, and on the basis of that they are depicting the economy on the basis of historical data like unemployment rate, the CPI consumer price index, flow of foreign funds in the economy. On the basis of the historical data of an economy, the future of the economy is being decided. If the unemployment rate in an economy was high, historical unemployment rate, historical CPI was high, historical flow of foreign funds was low, then definitely economy will not be tend to be any strong economy. Once we have to announce an economy is a strong economy, then definitely the employment rate should be high, the CPI should be optimum as per the consumer comfortability, affordability, and flow of foreign funds should be in manner so that the import and export requirement and balance of payment requirement of an economy can be met out. So, under the lagging economic indicators, these economic indicators are those indicators which depicts the future of an economy, which depicts the movements of an economy based on the historical factors, based on the historical indexes. Next is the coincidental indicators. Coincident indicators are, these are the economic measures that tend to mirror or move at the same time as business cycle indicates what economy is. A coincident indicators is a metric that shows the current state of the economic activity within a particular area. Coincident indicators are also important because they show economists and policymakers the current state of the economy. Under these coincident indicators, they move as the economy move, they move ahead, they move along with simultaneously along with the economic movement like the industrial production. If the industrial production of an economy is high, definitely economy will tend to be a more productive and more progressive. If the personal income, GDP, GNP, these are high in an economy, definitely the economy will tend to be called as the stable economy. And as we know clearly, GDP, gross domestic product, GNP, gross national product, these are the major economic indicators which clearly talk about whether as a layman point of view, the first thing is GDP. GDP talk about the economy is a strong economy or economy is a weak economy. Once a GDP is in the growing trend, GDP growth rate is positive. Once a personal income of a consumer of the residents of an economy is high, per capita called as per capita income, industrial production is high, definitely that economy will tend to move ahead and called as the strong economy. Every investor, whether the foreign institutional investors, the institutional investors or the individual investor, any kind of investor always want to make the investment in those kind of economy which are having the strong economic fundamentals. These strong economic fundamentals, as we have divided in three categories: leading, lagging and coincident indicators. Under the coincident indicators, these are the indicators which move ahead, which move along with simultaneously with the economic movements. These are the industrial production, personal income, GDP, GNP and interest rates. Interest rates of an economy talk about the debt market position of an economy. If the interest rates are high, definitely the if the bond market, if the coupon rates are high, definitely the debt market will be high, the interest rate will be high, and higher interest rate will talk about the strong debt market and simultaneously reversal impact on the equity market. because once a debt market would be strong, there is a higher chance for the weak equity market. But once a interest rate are optimum as per the inflation rate of an economy, definitely the equity market perform better. So, these are the major economic factors that affect the risk and return on an investment. These are in concise, we can say these are the economic indicators. First is the money supply. Money supply, if the money supply is high in an economy, definitely flow of money is high, the production will be high, and it will impact the higher production, higher industrial production, higher output, and the economy will become strong. The GDP, gross domestic product. If the gross domestic product of an economy is high, it will inculcate, it will develop the sense of belongingness, sense of stability of an economy, and the sense of productivity in an economy. Savings and investments. If the citizens of an economy are keen towards savings, keen towards investment, they are regularly making the investments. If the saving mobilization are high, then the economy indicators, economy pattern will be high, because savings and investments talk about the economic stability, the mental stability, mental health of the citizens of an economy. If they are tend to make the investments and they tend to make the savings regularly basis, then they are definitely announce an economy as a strong economy. The inflation rate of an economy. Take the example of Vietnam, take the example of Indian economy, take the example of Chinese economy. Inflation rate of an economy talk about the at what rate the inflation, the price of a particular commodity is increasing. It directly impact the buying capacity of a consumer. If the buying capacity of a consumer will decline, definitely it will adversely impact an economy, because if an economy has to grow, consumers has to regularly make a increasing buying pattern. If the buying pattern of an consumers will increase, it will increase the production of an economy. Once the production of an economy will increase, definitely the economy will become stronger and stronger. Industrial production, as discussed earlier also, industrial production directly linked with the consumer price index as well as consumer buying pattern. If the industrial production will be high, definitely the consumer is always willing to purchase the things, and the economy is tend to move, giving the employing the more factors of production like land, labor, capital, entrepreneurship. Once the more factor of production will be employed in an economy for increasing in the industrial production, definitely once a more factor of production will be employed in the economy, more money flow will become, and more money flow will become, definitely the economy will grow. Unemployment rate. Unemployment of an economy talk about at what rate the people are unemployed, or at what rate employment rate talk about at what rate people are employed. If the unemployment rate are high, the consumer buying capacity will be low. If the consumer buying capacity will be low, definitely industrial production will go down. Once the industrial production will go down, definitely the output of an economy, the growth of an economy will adversely impact. So, unemployment is the major factor which talk about the growth, the strength, the stability of an economy. Employment rate is also largely depend on the population size of an economy or the resource deployment of an economy. The resource generation of an economy is directly has a correlation, positive correlation with the population rate, population growth rate or the population size. Once the population size is high and resource generation capacity is same, definitely the unemployment level will become bigger and it will not be a good signal for an economy. The budget, the how to invest, budget is the planned expenditure, budget is the allocation of resources, what resources we are having, where to deploy those resources, how to utilize those resources, that is talk about with the help of budget. If the budget of an economy is good, is positive for the industries, for the production, for the consumers, for the institutions, definitely that for the society, definitely that economy is called as the strong economy. Every year Finance Minister of India announces the budget, financial budget, in which they are announcing various subsidies, various incentives for the MSMEs, for the poor people. So, on the basis of the budget, budget decides the economic movement. The budget decides the movement of an economy in the coming years. So, under this budget, budget is the major indicator of the economy. So, if the budget is favorable for the industries, for the consumers, for the society, in what manner the budget has been presented. So, the budget always be presented by considering all the factors, not only the MSMEs, not only the industries, not only the consumers, not only the individuals, society, but also all the factors have to be come up under the budget decision. So, once the budget is being decided, budget is being announced by the finance minister, then they have to look forward the industrial development, they have to look forward the social development, they have to look forward for the foreign investment, foreign funds flow development. So, accordingly the budget, first of all the investor is look forward the budget, what the budget is talking about, whether the funds are available for the industrial development, for the infrastructural development, for what the budget is for. So, according to the budget, the economy movement, economy near future movements is being decided. Next is the tax structure. Under the tax structure, there are two kind of tax, as we know. There is direct tax, indirect tax. Direct tax like the income tax, indirect tax like the GST, goods and service tax. The tax structure of an economy talk about whether the production will be high or low. Once the GST has inculcated into Indian economy, from then various business corporates, various business houses, various shopkeepers have opposed this GST, but the real thing is this: GST is a method, GST is a way to come up all the taxes under a single window, that is goods and service tax. There are various taxes previously, now there is a single window of tax, that is called GST, and with this kind of tax the investors are look forward. Investors prefer that economy is having a stable policy, a very clear policy about the tax collection, tax structure. So, tax structure, the tax structure also includes the tax rates, like the direct tax rates for the income tax. For an individual, as the direct tax rates has been changed last year, 5% up to the income of 250 to 5 lakh, 10% for 5 lakh to 10 lakhs. So, these kind of tax structure, what are the tax rates on the individual tax income. So, under the tax structure, the economic movement is being decided. What would be the tax collection? Because tax structure will decide the tax collection, and based on the tax collection, which is the actual revenue of an economy, which decides the economic movement, economic payment. So, next is the balance of payment. Balance of payment is used for the international trade. Once the export or import, this is the difference, balance of payment is the difference between the export and import of commodities and services being made in an economy. So, under the balance, if the balance of payment is having the deficit or the surplus, if the balance of payment is having the deficit, definitely the imports are higher than the export, which is not a good signal for an economy. If the balance of payment is having a surplus, definitely it shows the favorable balance of payment or the surplus balance of payment, which shows the strength of the economy, the self-sustained economy. Positive or favorable or surplus balance of payments talk about the stability of an economy, the self-sustainability of the economy. Economy is self-sustained, economy can sustain itself, economy is producing resources that much which can be utilized within the economy and can be exported if they are having the excess. So, balance of payment is a leading economic indicators under which the balance of payments talk about the how to move in the market, how the economy will move, how the economy will be having the foreign funds requirement, foreign funds availability. So, this is being decided under the balance of payment. Next is the interest rates. Interest rates is directly linked with the inflation, interest rate is directly linked with the CRR, cash reserve ratio, statutory liquidity ratio, the bank rate, the repo rate, reverse repo rate. So, the interest rate is directly linked with these kind of factors. Interest rate is being decided in India, interest rate is being decided by RBI. So, under the interest rates and all the commercial banks under the aegis of RBI, all the commercial banks are free to change, to decide their interest rate up to a certain parameters, under a certain parameters. So, under the interest rates factor, if the interest rate of an economy is high, definitely the debt market are performing well, and if the debt market is performing well, investor is keen to invest in that market. That economic indicators show about the economy is stable. If the interest rate is quite optimum according to the inflation, then it talk about the economy is quite stable, because interest rate, as a old proverb, interest rate should be move according to the inflation rate of an economy. But once the interest rate is higher than the inflation, it means economy, it is an indicator that the economy is falling down. If the interest rate is lower than the inflation rate, it means economy is growing. But what is the reason? Another reason, another interpretation is this: the government is not having the sufficient investment avenues where they wish to invest. So, sometimes interest rates are also falling down at the time once the government is not having the investment avenues, is not having the loan disbursement capacity, loans disbursement is low, then it is not a positive indicator for an economy. Next is the infrastructural facility. Under the infrastructural facility, the infrastructure of an economy, what actually is, what are the how much is the power plant, what are the power generation capacity, how is the power generation, power conservation, how the roads, railways, airways, how is the transports, communication, telecommunication, how they are running in the economy. The infrastructural facility of an economy, like the metro, bullet train, these all are the indicators for the infrastructural development. And if the infrastructure development is quite good, if the roads are good in an economy, is effective in an economy, then definitely that infrastructural facility will talk about how the economy is moving, because the success of an economy is depend on the infrastructure. Trends in capital market, trends in capital, if capital market is bullish trend or bearish trend. If the capital market is bearish trend, definitely this is not a very good indicators. In the last is stages of business cycle, whether the business cycle under the boom stage, trough stage, decline phase, recession phase, in which phase the economy is in the business cycle. So, accordingly these are the basic economic indicators which decides the investment pattern, or these are deciding how much risk and return associated with the investment in that particular economy is. So, these economic analysis is very much necessary as a first part of fundamental analysis. These are the references, and thank you very much.